Okay, welcome everybody to my live webinar, Basic Rules of a Healthy Economic Life. We're going to provide a lot of value for you today, so let's get started. Okay, first I would like to let you know a little bit about myself. My name is Jason Rodriguez. I'm the principal advisor at Prominent Insurance Services, and I'm in the wealth protection business with a very unique approach. I help families and businesses understand the path to proper protection by reviewing their current insurances and making them aware of any vulnerable areas that they may have and provide them with a recommendation. I also assist in finding money that they may be losing unknowingly and unnecessarily. So, that's a little bit about what I do, and I also consult businesses. So today we're going to have our webinar, Basic Rules of an Economic Life, Basic Rules of a Healthy Economic Life. And we're going to be doing a few series of this webinar so we can give people a handle on their personal economy. So as you see right here, you see this looks like plumbing material, something, a water pump, big water pump, two other pumps, and this is basically how money flows. This is your whole personal economy right here. And as I go through this webinar, showing you how to be better stewards of what you currently have. And I'm going to give you an example. So, you have lifetime capital potential in this tank right here. This tank is humongous because what comes through our hands from the time that we're starting to earn income to the time we retire, millions of dollars go through our hands. So that's why this tube is this big, and we may not believe so, but if I click on lifetime capital potential, I'll show you how much money comes through your hands, but we'll continue on. And I just want to show you, and then we have standard of living, your car, your entertainment, your home, your food, education costs, and entertainment. Then you have your protection that everybody needs in order to have a proper personal economy. You have the same thing. You have auto insurance, home insurance, medical coverage, disability, life insurance, long-term care, umbrella, wills, and trust. So I just want to go back. I'm going to show you how money works. Take it slow a little bit. So, money comes through your earned income, through your lifetime capital potential, through your monthly cash flow, through the tax filter. You see that right there, that's bolted on. Ain't no taking that off. That's bolted on to your lifestyle regulator through current lifestyle consumed and gone forever. See, this is how money, the natural flow of money, flows. And we all understand that in order to live the life you live in the future, you can't have your money flow like this, consumed and gone forever. We'd be in a bad situation when we desire to retire. So, in order to have a proper life when we retire, we got to have some money come through our earned income. We got to have some money come through our earned income, through our monthly cash flow, up into the savings and investment tanks. So when we stop working, when this tank gets cut off, no more money comes through there. We can be able to pull from these two tanks and be able to live the lifestyle we desire in the future as we live today. I have seminars all the time, and I ask individuals, I say, do you want to have more when you retire or less? I never heard nobody tell me they want to live off less. But if we don't put any money into these two tanks right here, your savings and investments, you know, then the reality is we're not going to have anything when it's time to retire. Our tanks is going to look like this. We have no resources to pull from, and can't depend on Social Security because Social Security or was made as a supplement. So, our future relies on what we do. And there is just basic rules, to a healthy economic life. And one of them is, you got to save first and spend what's left. So I like to say, you got to have some money come through your earned income and go into this tank. So you got to have some money come through here. And, the tax filter, he's going to get his. And I'm going to show you an example. Uncle Sam gets his. And you got to put some in here before it goes out to your current lifestyle. And then whatever you have left, then you spend. See, the difference between rich people and poor people is just a mentality. See, the rich save first and spend what's left. The poor mentality, they spend first and then save what's left. And when you spend first, 99% of the time, there is nothing left to save, because all the money that we get is consumed by current lifestyle expenses. And this is our current lifestyle expenses right here. The majority of money we get is consumed by this standard of living, this current lifestyle. Majority of our money, our cash flow, a lot of people that I meet and how I used to live, I get money coming in, it comes right here, it goes to my vehicle, it goes to my entertainment, goes to my home, goes to my food, and it's consumed and gone forever. I rarely had any money to put into these two tanks until I decided to live a better life and wanted to do like the rich do. So I desired that I'm going to do as they do, and I'm going to save first and spend what's left. So that's very important. It's a very important topic. And you got to treat yourself just like they do. So, and this is an example. And it's one I wanted to show you. You got to treat yourself like the government, like you your own personal government. And this is an example of a check. So this is not a real check, but this is an example of how your check looks. You get earnings. You may have some OT, you may have some commissions. You may participate in your 401k or any pre-tax insurance, things of that nature. But this is where I want to show you. This is where you have to add something. You see, if you look at your withholdings, you look at withholdings right here. Very important. You see the feds takes theirs, FICA, state, Social Security, state, and then you got local government. And before you even get anything, they get theirs. This is where you got to put yourself in. So you got to be listed right here, me, M-E, me. You got to have a line item like they have a line item. You got to take something out of your earnings every time you get paid like they do. You got to do the same thing as the government does if you desire to have something when you retire. Now, if the government, think over this, if the government didn't take their money before you got yours, if they waited for you to pay them, they'll be chasing a lot of us because we wouldn't pay them. It's just the natural order, it's just the nature of the human being. We find things to spend that money on and we say, I'm gonna give it to them next check. So they got smart and they say, no, we're not gonna be chasing you. So we're gonna take our money out before you get yours. So this is the same thing you have to do. You have to withhold some of your earnings right before you start to spend. So this is a great example of putting me, putting us as a line item right down here. We are part of this. So whatever it may be, 10% of your earnings, 15% of your earnings, 20% of your earnings, 30%, that's ideal. If you could put 30% of your earnings into those two tanks, as I showed you, you'll have something. So, so as your money come in and you withhold it like the government do, you right here. See, the government, before it goes anywhere, before it goes to your current lifestyle, the government is bolted on right here, tax filter. You need to be bolted on right here. So before you go to your current lifestyle, your money should be flowing right up into your savings, whatever it may be, 10%, 20%, 30%. But if you want to be able to live the lifestyle that you desire, greater than you're living today or the same as you're living today, you have to make some sacrifices. Or unless your tank is going to look like this when you retire and you're going to be in a bad situation. So we need to be able to fill these two tanks up with the 10%, the 20%, and the 30%. In some other ways, cut out some of your extravagances. You could save some money by limiting your cable bill. There's some expenses that's variable, some that things that can change, but some that's fixed. Your rent is fixed. Your mortgage is fixed. Fixed expenses. Your car note is fixed. Your home note is fixed. These are variable expenses. Food may be fixed. Entertainment is a variable expense. You may have some student loans, but you have some expenses that's variable that you can switch. And you be able to look at that by putting together a spending plan. And everybody should have a spending plan, knowing what your monthly cash flow is, what you get on a monthly basis, and what your monthly expenses is. And that's one of my gifts at the end of this. You email me, I give you my information, and I'll send you that PDF of a monthly spending plan, so you'll be able to have that. So, I just wanted to get over that point that is very, very important to put something away for yourself as the government does when they take money out of your check before you see it. So that's how you got to move, just like they move. You got to add yourself to that line item as well. So you will be local, personal economy. Yours will look just like that. You'll be right here, local. I'm local, personal economy, and I'm taking that money out for me and my future and my family. So that's very important. So let's go on to the next slide. Okay. And we want to show you on this slide, which is a very important slide, that reducing expenses is good in financial management. And I say that because there's only two ways to help people financially. Find better products that potentially pay higher returns, often requiring more risk. That's the first way, which most people chase. And the second way is be more efficient by avoiding unnecessary losses, by just cutting your extravagances. They say most money is lost on how we manage our monthly cash flow. So just being able to avoid the losses, if you and there's ways that you can avoid losses, by looking at how much you pay in taxes. There's ways to avoid losses, and we could talk about that as well. And I'm gonna be going over that in future webinars, how to avoid losses, things of that nature. So, but today we're just going to keep it basic on ways to better have good financial management. So this is an example of being more efficient by avoiding unnecessary losses. So let's just say you make $50,000 a year. Let's just say you make $50,000 a year, right? And you invest 10% of your money on an annual basis however you invest. And 10% of 50,000 is $5,000. So you invest $5,000 annually. And on that investment, you get an 8% return, which is moderate, nowadays, very, very aggressive. But you get an 8% return on the $5,000 you invest annually, and wherever you invest it, whether it be the market, whether it be real estate, whether it be wherever you may invest it, notes, wherever you may invest it, you take 10% of your annual operating expenses, which is 50,000, and you invest it and get an 8% return. So I just want to show you that being more efficient with your current resources, being more efficient, managing your money properly, knowing what's coming in, what's going out, is more efficient, is good financial management. So on that $5,000, that 10% of your 50,000, on that $5,000 you invest annually at an 8% return, your annual investment return will be $400. So if that $5,000 at 8%, you get $400 a year. So that's $5,400. At the end of 1 year, you have $5,400. And I just want to show you that. Okay. Now, just if you was to reduce your expenses, by 5%, you got some variable expenses in your life and you can reduce them just by 5%. That'll be a savings of $2,500 a year. So you'll save $2,500 by reducing your current lifestyle or just finding ways to be more efficient with the things that you do by avoiding unnecessary losses. You'll save $2,500. So return equivalent on that same $5,000 that you would invest in a market, in order to get a $2,500 return on $5,000, you would have to have an interest rate of 50%, which is unheard of. So you would have to make 50% on that 5,000 to get $2,500, which is unheard of, like I said. And this is just proof, which can be proven by the fact that 50% of 5,000 is 2,500. So this just shows you, what people do all the time. They think, hey, I'm gonna find better products that potentially pay higher returns, requiring more risk, or I need another job, or I need more money, or they chase rate of return. But it's just the proper way, as I'm showing you on the screen. Just by reducing expenses, you can be more efficient with your current finances, that you can have more money than you would invest in any other investment, making 8% return. So we're just showing you that we believe, and it's our philosophy, that we believe there is more opportunity to help serve our clients by helping them avoid the losses than picking winning investments. So this is an example of our philosophy, and this is a very important screen too, just to prove to the fact that if you desire to just be more efficient with your current resources and maintaining it and avoid the losses, then you can use that money to invest in a later date. So let's go on to the next slide. Now, there's ways that people purchase things, how you buy, borrow, and pay. So I'm gonna take you through 3 scenarios. And I know at one time or another, I was all 3. I mean, I was all of them, and I just want to show you for major capital purchase. And a major capital purchase is something that you can't, a thing that you can't purchase with your monthly cash flow. So a car would be a major capital purchase. You can't purchase that with your monthly income. A house would be a major capital purchase. Things that you desire that you can't purchase with your cash flow. So now we're going to go out. The first way is how to buy things. First, you have the debtor. The debtor works to spend. He has no savings, earns no interest, and pays interest. Then you have the saver. The saver saves to avoid paying interest. So he saves, he earns interest, and he pays cash. Then you have, which is a very important person, which we all trying to become and continue to become, a wealth creator. Saves and uses other people's money to maximize efficiency. Saves, he compounds interest, and collateralizes purchases. So that's a very important thing to buy. When you're purchasing something, you want to be the wealth creator. Now, when you're borrowing, so you got these 3 people: a debtor. When he borrows something, when he wants to make a major capital purchase, he borrows from a lender at highest market rates, using future earnings potential as collateral. That's what a debtor does. A debtor is basically someone that says, hey, I don't have the money today, and I want to purchase this vehicle, and I'm at my job for the next 2 years. So they're going to take a portion of your earnings. So, they're going to take a portion of this lifetime capital potential for that major capital purchase that you're going to purchase of a car. So, and what happens to your current lifestyle? This tank, every time a debtor, you purchase something else that you can't pay for, this tank gets smaller and smaller and smaller. And you constantly move in that direction. So then you have the saver. A saver saves to avoid paying interest, borrows from self, reducing current collateral position, and resets compounding. And this is what we do all day. We save up enough money. We save money in this tank, right? Not this, then put that down. You save money in this tank. When you want to make a purchase, what do you have to do? You have to drain it. And then what do you have to do to fill it back up? You have to earn it again. It has to come through your earned income, through your lifetime capital potential, through your tax filter, back into your savings to fill it back up. We're just trying to teach you a better, efficient way to make major capital purchases without resetting compound interest. So these are strategies that we can go further in depth in, but I'm just scratching the surface today. So let's go back to that. And then you have the wealth creator. Let me go back to the wealth creator. Wealth creator borrows from a lender at negotiated rates using own money as collateral and continues to earn uninterrupted compound. It's a beautiful thing. And we all desire to stay in this boat, be a wealth creator. It takes time to get there, and it takes discipline, and it takes strategies to be able to be a wealth creator. And it's just a philosophy difference. We all have the opportunity, no matter what your tax bracket may be, or no matter what your current income may be, as long as you're generating an income. Now, if you're not generating an income, there's really nothing, we can do. You have to first start generating an income, no matter what it may be. No matter what the amount may be, excuse me. And this is the way people make purchases. Now, we should all pay attention to that, because what we do as consumers, because America is a consumer nation, and we purchase a lot of things, we try to buy our way. We try to buy our way to freedom, whatever the case may be. We a consumer nation. So what does a debtor do? A debtor, same situation. He makes payments to the highest lender at highest market rates. As a debtor, you have no money in your savings. You have no money here. So therefore, every time you borrow from your lifetime capital potential, from your earned income. So this gets smaller and smaller, because you got people taking chunks out of here all the time. And majority of the time, you at the highest market rates, because you may have bad credit, because you overextending your credit cards. You're not your utilization is very high with your credit cards. So therefore it has an impact on your credit score. The debtor is a bad place to be. Then you have the saver. He makes payments to self to get back to where they were before the purchase, giving up the interest their money would have earned. So same situation, you gotta, this is called self-financing. Then you have the wealth creator, makes payments to a chosen lender, allowing own money to earn uninterrupted compound interest, maximizing the benefits of their prior reserve account. Now, let me give you an example of what a wealth creator do, just to show you from these two tanks. Now, when a wealth creator, what he does is first, let me draw, because Worps, he has a different mindset. He earns income. It comes to his monthly cash flow, just like Uncle Sam, as they take out their portion for FICA, for Social Security, for state and local taxes. He is also a line item on there, and he pays himself as they do. So before he spends anything, he starts to save money, his extra cash flow. He starts to build up this saving. So every time he gets a check, whether it be bi-weekly, monthly. He puts money before he spends on any of his bills. He puts money here. So this is his thing. Before he spends on any bills as they take, he puts a portion of it, whether it be 10, 20, or 30% of his earnings, he puts a portion of it. So this is the wealth creator. I'm showing you the wealth creator right now. He puts a portion of it. So he keeps doing that every check. So what happens to his savings over time? He starts to grow. And we all know so this is what he does, as I explained, he puts money in it, and then whatever he has left after he puts his 10, 20 to 30%, because he saved first and now he spends. So he puts his money, now the money goes, the money goes to his mortgage, goes to his auto, his insurance, travel, food, entertainment, and college expenses or student loans. But he makes sure as these things get paid, because when you pay this person, it's coming out of, it's a asset for them and a liability for you. Anytime money goes out of your personal economy and pays somebody else, this is their asset and it becomes your liability. So a wealth creator, before they get paid, he takes it out the same way the government does. He got a little line item that it says me, and that me is either 10, 20, or 30%. And he puts it in there, and over time this grows. And then when he wants to make a purchase, he collateralizes purchases through a financial institutions, or there's institutions that we can do this, but I'm gonna give you an example of what he do. So he say, hey, I wanna make a major capital purchase. And he says, I wanna borrow $5,000. So he takes it, collateralizes his money, so his money is still growing, uninterrupted compounded, while he borrows the funds from a financial institution or insurance company. And what he does then, after he makes the payment, because now he's going to have to make the payment anyway. Either you're making it to GMAC, or you're making it to Ally, or you're making it to Citadel, or any of these companies. Now you're going to have to make it back to yourself. So same situation, you start to pay off the liability, but his money continues to grow. His money continues to grow, and he has more funds to borrow. But we'll go into that as we go through our basic rules of a healthy economic life series. But this is an example of a wealth creator. So let's get back. So let's go. And this is an illustration of the debtor. Starts at the zero line, goes down. Anytime he wants to borrow something, he has to borrow below zero, and then he gets back to, he pays it off. Then he wants to borrow something again. So this is a continuum. And at the end of the cycle, you end up in the same position. Then you have the saver. The saver, same situation. He's above the zero line. So he saves. And what does he do when he get all the way up there? When he want to make a purchase, he drains the tank. Remember we showed you that? He drains this tank right here. He wants to make a purchase, he drains this tank. So he's nearly back to the emergency fund, zero line. And then what he does, he's nervous. We all get nervous when we right here, no savings. So we start to save again. The money comes through here, goes back in the tank, and we start to save again. Then we want to make another purchase. We drain the tank. And then we go through the same cycle, earn income, life. We save a little bit, and then we drain the tank. So that's a saver, and they end back at the same point they was at. So then you have the wealth creator. The wealth creator does the same thing, but a little bit different, just a different ideology. So the wealth creator saves just like the saver does, but when he wants to make a purchase, he does it a little bit different. He collateralizes his purchases, uses other people's money, while his money is still growing uninterrupted and compounding over time. And as he starts to pay himself back, he's paying the institution back, and his money's still growing. So he never takes anything out. And then when you look up, he's all the way up here. But while the savers and the savers and the debtors is at the same, let me go, hold on. Let me go back. See? So they're at the same line, but he's all the way up here. By collateralizing purchases and by being more efficient by avoiding unnecessary losses and taking advantage of opportunity costs. And these are concepts that we'll teach you as we go further in our basic rules of a healthy economic life. So hope I'm providing value thus far. And I know you may have a lot of questions. So at the end, I'm gonna give you all my information so you can reach out to me and we can look at your situation and make you more efficient. Okay. And we're just gonna go through another tool to show you that debt, proper debt used improperly is slavery, installment buying. And so let's just give you an example. If you just any balance, and for this state, we're going to use a credit card balance. So if you hold a credit card balance of 10,000 for the lifetime of the loan, you keep a balance of 10,000 on your credit cards, and the credit card interest rate is 18%. And we still got that moderate, we still got that aggressive investment return of 8% here, depending on what you do. So let's just calculate that. So the first year in interest, you'll pay $1,972, and if you was able to invest that 19, if you was there, it just shows you same situation that year. Let's just go. This would everybody would pay the first year to the lender, and the interest you pay over time. Just we're going to start with this first one. The interest you pay at 18% over 40 years would be $78,000 to the credit card company. So that's why they like to give, credit cards. And if you was able to invest $1,900 over 40 years, this would be after 40 years, $1,900 at 8%. At 8%, you would make $510,000 in 40 years just by investing $1,972. And it just shows you. And that same $1,972, that's why they love credit cards even more. $1,972 at 18% over 40 years, how much they get. They lose some money at that case as well. But it just shows you that debt could be a heavy cost if you're not utilizing it properly. And it shows you, no matter what the interest rate may be, if you break this interest rate down to 8% with certain people, it's still potential to the lender, available to the lender at 8%. You still over 40 years, this is how much money you paid out in interest. So it just shows you that you want to be very mindful of debt. Very mindful, because debt, you may pay this out in 40 years, but when 40 years come, you don't have that in your tank. You don't have $235,000 to retire off. So you want to be very careful when it comes to debt and purchases. Okay. And we're just going to give you some examples of the problem with consumer debt. What is it? What's the problem with it? One is the obligation on future earnings. You lose capital to purchases and financing costs forever. So you never get the capital that you spent out and the financing costs. You don't get that back. And half the times, the things that we do purchase outside of homes and things of value, they depreciate immediately. So we can't even get no money back if we desire to sell the things that we purchased. And we always a debtor to the creditor. A debtor to the creditor. And we lost control of our money. We gave it to others to use. And consumer debt is an inefficient purchasing strategy. The initial purchase is lost, as well as the interest owed, causing further loss that can compound and spiral out of control. And we understand that if we don't control our debt, it can definitely spiral out of control. and we be in a bad situation. So and I always say with debt, and what helps me with making purchases, I say, so if you got something, let's just say a lot of individuals, we like to buy clothing, expensive shoes, $1,000 shoes, or whatever the case may be. I look at it a lot of times as I look at purchases as hours at my place of employment. So for example, if I'm making $20 an hour and something costs $1,000, I'm saying, wow, it's going to cost me, how many hours is that going to cost me at my work in order to make this purchase? So let's just keep it. So for every $100, that's 5 hours of work. So that means if it costs $1,000, that's 5, 10, 15, 20, 25, 30, 35, 40, 45, 50. That's 50 hours of work for $1,000 purchase. So if I see something that costs $1,000, and I'm making $20 an hour, and I have to work, I have to stay on my job for 50 hours in order to make this purchase, and I have to really evaluate that. Is this purchase worth 50 hours of my time dealing with people I may or may not like? So if you look at it like that, you'll probably add value to that purchase. A lot of people don't look at purchases as hours at their place of employment. So when you're purchasing something, no matter how small it be, making $20 an hour, something costs $200, that's 10 hours. That's a day in 2 hours. If you work 8 hours a day, that's a day in 2 hours. One whole day in 2 hours, I got to put in to make this purchase. So when you start to look at that, and then, we got to only spend when it's necessary and according to our income. And, it's just, these are the concepts that we have to have. And this slide is the economic squeeze on capital. And we know it is true. And we got two economic squeezes. One is external pressure, inflation. And what does that do? It erodes buying power by increasing price of desired goods and services. So you may go to a store and say, man, this isn't expensive. No, it's not that expensive. It's just that your money has lost its value due to inflation. So something that cost $1 in 1980 would cost $2.65 in 2010. So your money just lost its purchasing power. So when you go buy that gallon of milk, or you go buy that loaf of bread, and you used to pay $2, now it's $5. It's just that inflation. The price of goods and services increase where your income may have not. So, these are the times that we're living in today. And then the internal pressures, the things that we control, consumer debt, consuming buying power and financing costs are allowed to compound. So it consumes your buying power, when you allow your financing cost to compound, meaning it gets too big and your financing is taking all of your money, the interest that you're paying more in interest than you're able to pay on the principal. So it consumes buying power. And we know it can quickly snowball out of control. And that's debt. And debt is the only purchasing option for large or uninspected expenditures when one has no capital. So as wage earners, we should always plan to save something from whatever we are paid, so we don't have to have that, consumer debt all the time, and we be able to be more efficient with our current monthly income. So that's very important. So, appreciate you taking some time out with me. You can reach me at, it's my information right here, Prominent. We got you covered. My email is jason@prominentagency.com. Telephone number 302-351-3368. You can reach us on the web, email me, inbox me, and you can contact me so I can show you how to be more efficient by avoiding unnecessary losses. And as a gift, I have a PDF copy of Becoming Your Own Banker and also a PDF copy of a spending plan worksheet. So you can start to get on track of what you got coming in and what you got coming out. So you can start to track it and be more efficient with your current lifestyle expenses. So I appreciate you taking time and listening to this webinar. We'll be doing these every 2 weeks, going over concepts that may be familiar or may not be familiar. We want to add value, and our job is, to make sure that we all on the right path to financial freedom. And our next webinar is learn how to control the money in our own personal economy, the way banks control money in the general economy. And you can register in advance for this webinar. Here's the link right here. You can copy this down, and it's May 25th, 2017. That's a Thursday at 7 p.m. And it's the basic rules for a healthy economic life series part 2. We appreciate you. Thank you for tuning in. Any questions, you can inbox me. You can email me. You have ways of contacting me. I want to help you. And I want to give you this PDF copy of Becoming Your Own Banker. And I also want to give you a PDF copy of Spending Plan Worksheet. So I appreciate you. And until then, next webinar, have a pleasant day.